terrifying new indicator that America is heading for a recession. The probability of the United States entering a recession within the next 12 months has climbed to 43%. This figure comes from a recent survey conducted by Deutsche Bank. The survey included 400 participants and was completed earlier this month. It reflects a growing sense of unease among investors, economists, and business leaders. While key economic indicators such as low unemployment and stable consumer spending suggest that the U.S. economy remains resilient, consumer sentiment data now points to rising expectations of a potential downturn. The survey was conducted amid increasing market volatility and uncertainty over policy direction from the Trump administration. Concerns are mounting over how ongoing trade conflicts and the global economic environment might shape the outlook for the country. There is also an increasing fear of stagflation, a situation where inflation remains high despite a slowdown in economic growth. The possibility of stagflation has led to serious discussions among economists about the potential risks to the broader economy. As inflation continues to rise, many believe the Federal Reserve's current monetary policy may not be sufficient to avoid an economic slowdown. Government debt and trade deficits also continue to weigh heavily on the economy, adding to the uncertainty that is driving pessimism among investors. Federal Reserve's actions and projections. Federal Reserve Chair Jerome Powell attempted to calm the nation last week. He spoke of resilience and stability, claiming that the economy remains strong overall. Powell cited significant progress toward our goals over the past 2 years. However, the facts tell a more complicated story. The Federal Reserve has revised its 2025 economic growth estimate downward to an annualized 1.7%. This projection represents the slowest pace outside of the COVID-19 recession since 2011. Such a bleak projection could serve as a red flag indicator that a recession is on the horizon. The Federal Reserve has also raised its core inflation forecast to 2.8%. This is well above its 2% target, following a 2-day policy meeting held last week. Officials still project returning to the 2% target by 2027, but many economists believe the near-term path could be rough. The recent changes in the Fed's economic outlook have sparked renewed concerns about the health of the U.S. economy. In particular, the slowdown in projected growth for 2025 is causing economists to question whether the country could be heading into a long-term economic slump. Moreover, persistent inflation could lead to higher interest rates, which would increase borrowing costs for consumers and businesses. Higher borrowing costs would make it more difficult for people to buy homes, cars, and other big-ticket items. This, in turn, could reduce overall consumer spending and lead to a further deceleration in economic growth. Inflation and stagflation concerns. The Federal Reserve also raised its core inflation forecast to 2.8%. This is well above its 2% target, following a 2-day policy meeting held last week. Officials still project returning to the 2% target by 2027. However, the near-term combination of higher inflation and slower growth is drawing increased scrutiny. Economists are warning about the risk of stagflation. Stagflation is a dreaded mix of sluggish growth and persistent inflation. It is a scenario not seen in the U.S. since the early 1980s. During that time, gas lines snaked around blocks, and interest rates soared to punishing heights. Powell has tried to dismiss this comparison. He told reporters, "I wouldn't say we're in a situation that's remotely comparable to that." However, some economists disagree. They argue that the current economic environment has striking similarities to the stagflation period in the late 1970s and early 1980s. For instance, both eras have witnessed a combination of rising prices and slower economic growth. Moreover, many experts worrying that the Fed's current monetary policy may not be enough to avoid a similar economic crisis. One of the main challenges is that inflation is being driven by supply-side issues, such as high energy prices and supply chain disruptions, rather than just demand. This makes it more difficult for the Federal Reserve to address inflation with traditional interest rate hikes. Economic projections and recession risks. Barclays analysts said that market-based indicators are consistent with only modest slowing. However, their projection for U.S. growth this year stands at 0.7%. This is close to recession levels. While politicians argue and economists debate, American households are already feeling the squeeze. Grocery prices remain stubbornly high. Rent increases continue to outpace wages in major cities. Small businesses, once the backbone of local communities, are finding it harder to access capital or plan for the future. This is occurring in an atmosphere thick with uncertainty. Markets have responded with heightened caution. Investor sentiment has shifted, with many traders reducing their exposure to riskier assets. Some investors are looking for safer alternatives, such as government bonds or precious metals, to protect against a potential downturn. The shift in investor behavior is another sign that people are increasingly concerned about the possibility of a recession. Investor sentiment and trade policy uncertainty. Bond investor Jeffrey Gundlach of Double Lean Capital recently told CNBC that he thinks it could go either way. He placed the likelihood of a recession at 50% to 60%. This is higher than Deutsche Bank's more reserved view. In a research note published on Monday, Morgan Stanley warned about ongoing trade policy uncertainty. They noted that this uncertainty is contributing to an uncertainty shock due to ever-evolving tariff policy. Investors are concerned that it could morph into a slowdown or even a recession. Morgan Stanley continued, "What's really at the heart of the conundrum is that the U.S. might be at risk for a bout of stagflation, where growth slows and inflation remains sticky. The unpredictable nature of trade policies under the Trump administration is fueling fears that the situation could escalate further. Tariffs on Chinese goods and other trade restrictions have already created significant disruptions in global supply chains. Some experts are worried that the uncertainty surrounding trade policy could make it more difficult for businesses to plan for the future. This, in turn, could slow down investment and job creation, leading to even slower economic growth. Moreover, the possibility of new tariffs on imports from other countries could further strain the global economy. Recession watch and tariff risks. Meanwhile, the UCLA Anderson forecast, a closely watched forecasting center, recently issued its first-ever recession watch call. The group cited tariff risks as a key factor behind its warning. They pointed out potential policies being discussed by President Trump, who has proposed sweeping tariffs on imports. Compounding the anxiety is the return of aggressive tariff rhetoric from Trump. His proposed Tariff Liberation Day is only a week away. Although the full details remain a mystery, the impact of even floating such a policy is already being felt. Economist Clement Bohr wrote that such measures could trigger a downturn within the next 1 to 2 years. Bohr added, "If all your wishes come true, you could very well be the author of a deep recession. Not simply a standard recession, but a stagflation." The continued escalation of trade tensions with China could also have significant implications for global markets. If tariffs continue to rise, it could further disrupt global trade and lead to higher prices for consumers. Such an environment would be a recipe for economic hardship, especially if wages remain stagnant.